Now, the first place we need to start is with your trading edge. Most traders experience an enormous amount of losses, an enormous amount of stress and pain. And then when we really dig deep and have a look at their trading strategy and their trading edge, we find out they don't even have an edge in the first place. So what I'm going to do in this video is share with you exactly what I share with my six-figure traders to ensure they have certainty that they actually have a profitable edge that they're executing on. And right now you may be confident in your strategy and your edge, but I guarantee you I'm going to share things in this video that you're probably overlooking. And I'm going to share with you exactly what you need to do to ensure that you have a trading edge moving forward. And that way you can trade with certainty and you can ensure that if you dedicate 6 months to a year trading, you'll actually end up profitable. So let's get into it.
Okay, so let's start with what even is an edge and why is it important? How do you find one? How do you develop a trading edge? Well, all you need to ensure as a trader is that you will win more times than you lose in the future. So we can define a trading edge as this: win more than you lose as a trader. Now, does that mean that every single trade you take is going to be a win or is going to be profitable? No. The truth is you're going to have a sample space of trades. You're going to have a probability. You're going to have an edge. And over 10 trades, you may win 5 of those trades. You may win 6 of those trades. You may win 4 of those trades. Now, depending on your risk to reward, what you want to ensure is at the end of that larger sample space, you win more than you lose. And you end up with what is a profitable edge. So, as a trader, the way we go off and develop an edge is we go through what is back-tested data or what is previous data in the market. And we are testing this previous data to find that if these certain factors line up, it provides what is a profitable edge over a large sample space. Now, one thing to really hammer home with a trading edge is that a trading edge doesn't mean you're going to be profitable on each individual trade. It's not about being correct on the individual trade. Rather, a trading edge implies that you're going to be profitable over a larger sample space. Okay, that's very important to establish now, especially when we then get into the mindset work and the expectations later in this 30-day series. But what you're doing as a trader is you're going through back-tested data and you're identifying that certain factors, certain maybe technical analysis factors, or depending on how you analyze your charts or your trades, it may be fundamental, it may be partly sentimental, whatever it may be, you get an idea that if these factors align, I have what is determined as an edge, a profitable edge over a large sample space that I want to buy at this point in time because it's happened in the past over and over. So what you're doing is you're going through back-tested data to figure out what those factors are. What are those factors that give you a profitable edge? And what you're going to do is you're then going to trade real-life data and when you see those factors aligning in the market, just like they did in your previous back-tested data, you're going to take a trade with the hope that it's going to go in that direction more times than not over a large sample space. Now, does that mean it's going to be profitable on that individual trade? Not necessarily. Nobody really knows the outcome of an individual trade. But if you took this exact setup over 100 trades, you know that you'll be profitable. Okay, you know you'll be profitable over a larger sample space.
If you haven't made a single dime from any of my videos yet, I've got something for you. I've created a free quiz which is going to tell you which trading mindset you have, as well as give you the specific steps you need to take to profitability. Click the link in the description and get started.
So our job as traders is to do, firstly, to identify what are those certain factors through previous data that gives us an edge moving forward. And our job is to itemize and identify those specific things, those specific factors or criteria, call them what you want, that through back-tested data give us a probability, an edge moving forward. And the way your edge plays out is through what could be referred to as a self-fulfilling prophecy. Other people are aware of these factors. And through the simple law of supply and demand, there is a self-fulfilling prophecy in the market. Therefore, what we need to do as traders is identify what those factors are, put those factors into a mechanical system, and then consistently show to the market executing when those factors come up without the expectation of that individual trade being profitable. So we can be around for long enough to let that larger sample space play out. Now, we're going to talk extensively in this video on how you can actually go off and do that. But there's one additional thing I want to talk about here. Now, most of you watching this right now probably already have a strategy that you've already back tested. And just to hammer this idea home, when you go through that back tested data, you will see that there's a sample space there. There are some wins, there are some losses. Some wins, some wins, some wins, some losses. So you know that maybe your wins are a 3-to-1 and your losses are maybe a 1-to-1. You take a 1% risk, right, on those losses, and you experience a 1% loss. Or you have every win's a 3R. It's a 3 times what your losses are. Okay? So let's just go through and say that 1% and these wins are 3%. All right? And 3%, 3%, 3% on average, 1%, 1%. These losses. Okay? So when you're looking at your back-tested data, when you look at it from a broader perspective and you look back on it, you realize that you win more than you lose, right? Because of your risk to reward and because of your strike rate. So you're profitable over a larger sample space. Over a larger sample space. But on each individual trade, you may not be profitable. You may be profitable on some, you may not be profitable on others. These two, you're not profitable. So when you look back on your back-tested data, over a larger sample space, you're going to end up profitable. But on those individual trades, you may be profitable, you may not be profitable. So as a trader, you need to recognize that an edge isn't about being profitable in each individual trade. It's about being profitable over a larger sample space. And what we need to do first and foremost as traders is identify what those factors are that lead to a profitable edge over a larger sample space. Again, it's not trying to be right on each individual trade. It's about being right over a larger sample space. Okay? Now, the way you do that is by either having a positive strike rate, a strike rate that exceeds 50-50 or 50% strike rate with a 1-to-1 risk to reward. That will make you profitable. Or you can have a strike rate that is below 50%, but then you need to start to increase your risk to reward. Okay? And you need to have a greater than 1-to-1 risk to reward. Now, the different strike rate to risk to reward ratios, you need to test this yourself, because you may have a very, very high strike rate and a very, very low risk to reward. But what that means is psychologically, you're going to experience less losses. And as a trader, that may be important to you. I know for me, the way I prefer to trade is I tend to be more risk averse. I would prefer to have a higher strike rate and a lower risk to reward, because I know that that's what works for me. That's what works for lifestyle. That's what works for everything I do. And that may mean I take less trades, but it means that I can put more size behind the trades I take. So these are all important considerations that many traders don't factor in, but you need to think about it from a long-term perspective. You may just be starting now, but you want to think about in 3-5 years, would I prefer to have a higher strike rate? Therefore, I may take less trades, I may trade less, but I can put more size behind the trades I take. That's the personal approach that I prefer. But some traders are happier to have a lower strike rate. They're happier to trade more, sacrifice a little bit of their life, a little bit of their lifestyle, live a little bit more of a stressful lifestyle. But in return, they tend to have higher risk to rewards. Okay? So those 1 or 2 trades they take, maybe they have a 10 trade sample space and they take 7 losses, but those 3 wins are very, very profitable, maybe a 10R trade. And that covers for all the losses. So you want to factor these things in of how you like to trade. Okay? And you may learn your strategy from a particular education company or from a particular mentor, but that doesn't mean you can't add additional factors to, maybe have an additional filter in a higher time frame that increases your strike rate but lowers the amount of trades you take. Or you may remove filters from higher time frames and be more aggressive, which lowers your strike rate and increases your risk to reward. So these are all things that you need to take into consideration and factor in. Okay. But what you're going to do is you're going to go off and you're going to back test the market, and there are certain factors you need to be looking for. Let's run through what those factors are. Okay. Now, the first factor you need to look for and you need to test and you need to ensure that you're going to be profitable more times than not with is when we talk about your entry. Okay. And the entry point is specifically in the market when you enter the market, when you put your risk on in the market. Now, your entry can be broken up into multiple different components. You have what is referred to as an area of value, which is typically on the higher time frames. Okay, and it's going to be completely different depending on what strategy you trade. Maybe you start off by looking at the daily and the 4 hour to get an idea of an area of value that is of interest to you as a trader. Or you may start on the 4 hourly and hourly and then drill down to lower time frames, depending on the way you trade. And then once your higher time frame is in a good area of value based on what you determine your edge to be, based on backtested data, you will then go down to a lower time frame to pinpoint an entry criteria. I know some traders that only trade one time frame, which is fine. There's no right or wrong way to do it. So you would just get rid of this. You wouldn't have an area of value. You would just look at the specific entry criteria. Okay. Now, I'm not trying to impose a certain belief system or a philosophy to trade, but what I want to do is rather try and give you a template or an idea or a format that you can fit your ideas into. Not everything will be relevant, and that's okay. So you want to look for an area of value and an entry criteria. You want to ensure that your entry has a positive edge. It plays out more times than it doesn't. Okay. So when you go on backtest, you want to be backtesting these specific things. You want to be, all right, on the higher time frame, what area of value are we in? Maybe there's a certain structure on the higher time frame that's giving you a bullish indication, or maybe there's a certain level at this price that's giving you an indication of a bullish move here, or there's an EMA or whatever it may be. You need to figure out what those factors are for you. And then on the lower time frame, what's the specific thing that the price does? Maybe it's a price action pattern, or maybe it's volume kicking in, or maybe it's breaking previous highs. Whatever it may be, you need to determine what that is for you. And what you're doing when you're backtesting is you're ensuring that with the combination of my area of value and my entry criteria, when those specific things are present in the market, right, I have a positive edge. I have a positive expectancy in that moment, meaning that this has shown up in the market more times than it hasn't. It's played out more times than it hasn't in the past. Okay? Then the next component you want to look for, because when you get into a trade, that's not the end of the trade. You then have to manage that trade. The next component is your management, really. But what it is specifically, if we break this down into many different components, is management is where you initially put your stop loss. So your initial stop loss placement. Where is that? Okay, and you want to ensure that when you're testing that, you figure out a management that works, that you put your initial stop loss, and more times than not, it plays out. And then, do you have a break-even rule or not? You want to test that as well. Is that creating a positive expectancy for you, or is that cutting profits short? And then you want to figure out, are you doing take profits? If so, where are you putting your take profits? Okay, is it a 3-to-1? Is it a 1-to-1? Is it a 4-to-1? What is it specifically that you have a profitable edge with? And don't take anybody's word for it. You want to have a look at the data. The market will show you all that you need to know. You just need to figure out whether that's a profitable edge or not. And then maybe take profits don't work for you. So you have an active stop loss management, okay, where you trail your stop loss. Again, have a look at the data. What does the market show is most profitable for you? But at the end of doing all this testing, you want to ensure that you have a positive edge, a positive expectancy. And then you want to go in there and plan some risk management. And maybe you run some form of a Monte Carlo simulation. You get an idea of, how many losses you can experience with your particular strategy. And you go in there and you can have a look that, all right, for my particular edge and my particular strategy, it's not uncommon to experience 5 losses in a row. And based on the probability model, I can expect sometimes that I'm going to experience 5 losses in a row. well, then you have to understand the psychology behind that. Are you comfortable taking 5 losses in a row? Are you comfortable? Maybe you have funded accounts. Is that part of the drawdown buffer with the funded accounts? Okay. So you want to figure out, how much am I risking? Is just risking 1% good for me? Or do I also want to scale down my risk as I go into drawdown? Okay. Or is it just better because maybe I have a lower strike rate, I take more trades, I'm going to actually limit the amount of risk I take. Or depending on the setups I take, maybe when I'm taking slightly more aggressive setups in different market conditions, I'm going to risk less because it's slightly more of a risky approach. And when I'm in a higher probability market condition with a very high probability setup, I'm going to risk 1%. But again, you want to figure out and you want to do the math and the statistics to test what will actually yield you a positive expectancy. That's really what you're focused on. You're looking at ensuring that you have a positive expectancy. Okay, so by the end of going through all these factors and testing it in the back-tested market, in the previous market conditions, you're based on your entry, your management, and your exit and your risk management. You got to ensure, and you need to make sure that if you did that more times than not, you're going to end up profitable. Okay. Now, there comes a point in your trading where you become so convinced that your strategy is profitable and that it's going to work that you are now run by confirmation bias. And all that you let into your mind is that this strategy is profitable. Maybe you're in a community that raves about how good your trading strategy is. There's no better options out there. And we get blinded into thinking that our strategy is the only way to go and that it's always going to be profitable. And then what happens is you go through back-tested data and now you're so primed to seeing your trading strategy play out that you're only pinpointing ideas of where it actually has played out, just to confirm your previous belief and your previous idea that your strategy is and will continue to be profitable. But then you go and trade your strategy in the real life market and you can't quite replicate the back-tested data, the back-tested idea you came up with. And the reason why that is because you haven't run a double blind test on your particular strategy. So what you need to do now is you need to go in and run a double blind test on your strategy, really to break confirmation bias. So what you're going to do after you've done the initial testing to ensure that your strategy has a positive expectancy is you're going to go back through that same set of data and you're going to have a look at what are all the drawbacks and risks. What are all the uncertainties that I have in my strategy, and what are all the vulnerabilities of the strategy? Now, something that I'm seeing very common with my 12-week program students and with my one-on-one coaching clients as well, when we go on to run this double blind test, one common vulnerability we find of a strategy is that when we go and initially test our strategy to find that it has a positive expectancy, what we do with our testing is we isolate a particular market condition where this strategy performs very, very well. And then because of the fast-paced nature of backtesting, we can very easily skip over market conditions where our strategy doesn't perform well. Okay, and we just very easily just ignore that and move on to the next where we see it doing very, very well. But then think about it, when you're actually trading the different market conditions and you're sitting at your screen and you're forced to face the market condition we're currently in, it's not very easy to skip over it like we did in backtesting. And what can sometimes happen is we then trade the strategy the same way we do in this new market condition based on testing in a different market condition. And we're trying to impose a strategy onto a market condition where it doesn't perform. So one of the biggest vulnerabilities of individual strategies is that they don't always perform very well in all market conditions. They may perform very, very well in an impulsive market condition, but not well in a corrective market condition, or vice versa. So what's important to do is go back through all market conditions and have a look. If I traded this strategy just like I do in this market condition, how would it actually perform? And what you start to see is you start to see more losses. You start to see, you're getting taken out for break even and then it's still running in your direction. You start to see the vulnerabilities in your strategy and in your initial system that you tested. And it's not comfortable to do, it's not nice to do, because what we like as human beings is to be reaffirmed that what we're doing is right and it works. But this is necessary if you're dedicated to consistent long-term profitability. Traders who are just committed to getting a quick win and a dopamine, they're not going to want to do this. But those who are committed to long-term success as a trader, they're going to do this. Okay? And then what you want to do, now that you're aware of some of the new drawbacks, you're aware of some of the uncertainties, some of the vulnerabilities, for example, market condition, what you can then do is ask yourself, all right, what's a new process, or what's a new system, or what's an adjustment I can make to my risk management, or what's a certain filter I can add on the higher time frame, or a filter I can add for market conditions, to ensure that I've actually now put a proper process in place to manage this vulnerability. And you might see through different market conditions, everybody in your community starts to take more and more losses, where what you've done is you've added an additional filter to reduce risk in a certain market condition where you know your strategy doesn't perform well, or you've decided not to trade at all in that market condition. And what's happening is you're just more prepared, and you've added an additional layer to your edge to ensure that year round and through all seasons, you're more profitable. And again, it may limit the amount of trades you take in that particular season, but then what you can do is you can reallocate your risk and go very aggressive in market conditions where you know your strategy performs well. Okay? Now, so you've gone through, you've ensured that your edge is profitable more times than not over a large sample space. You've figured out some of the more minute details about your edge. Do you want it to have more of a greater strike rate or a lesser strike rate? You've also gone in and you've done a double blind test to find some of the risks and vulnerabilities, and you've planned and prepared for that. Now, chances are some of you already have your trading strategy. You've been trading for a little while, and you also have some data. So one additional thing I encourage each and every single one of you to do is to do some optimization on your current edge and go through the current data you have and ask yourself these questions. Firstly, what's working very well with your current edge and with your current trading? And go through the data objectively as you can and figure out what setups are working, what pairs or cryptos or stocks that you trade that respond very well to your strategy. What times of the day do you trade that work very, very well? Look at all these factors and figure out what's working and how can you do more. And then also ask yourself, what's not working? What are you trading that just doesn't respond well to your strategy? What times of the day or times of the week do you trade that just aren't very profitable? And how can you do less of these things? So what you're doing is you're having a look at the data you probably never look at, and you're optimizing that data based on real data you have with your particular strategy to make refinements to ensure that your edge is more profitable. And then also you can do an 80-20 analysis. What are the 20% of setups you're taking that yield you 80% of your results? And now you can maybe even risk more on those less setups because you're trading less. You can enjoy more of your time. You can have less stress as a trader. So you want to do and you want to ask yourself these questions to optimize your edge to ensure that your edge is actually profitable and you're reaping the full capabilities of your edge. Okay? And depending on where you are in your journey, you're going to have different amounts of data. But now that you start to work on your edge and ensure that your edge is actually profitable, you've run a double blind to figure out what the vulnerabilities are, you've planned for those, and through any previous data you've had, you've gone through that, you've filtered through it, you've optimized it to ensure that by the end of all this information, all this data, you have your most profitable edge. What we're going to do tomorrow is we're going to now talk about organizing your edge and putting your edge into a mechanical system, because once you're certain you have a profitable edge, you need to ensure that you can actually show up to the market every day, despite how you feel, irrespective of whether it's raining outside or it's sunshine or how much caffeine you've had or whatever, and you can consistently execute on that edge to reap consistent profitability. Because the way you have consistent profitability is by consistently executing on your edge over a large sample space and approximating that edge. And that's how you have consistent profitability. That's how you make money as a trader. So now that we have an edge, and make sure you do by the end of this video, you can now structure this edge into a mechanical system, which we're going to talk about tomorrow, to ensure that you can consistently execute on it. Okay? Now, if you found this useful, please share the YouTube playlist with your trading community. Let's get this trading psychology mastery series out there. Make sure you implement the ideas that I've shared with you in this video, because really they're not valuable unless you implement them. And if you enjoyed this video, you got a major takeaway from it, comment it so you can share what that is with everybody else. And make sure you subscribed, and so you're ready when I drop the video tomorrow, and you can jump in and you can continue working through the trading psychology series. And the only last little thing I'll mention is that we have the new trading psychology archetype quiz, and that quiz is going to help you identify what trading mindset you have, and it's also going to give you the specific roadmap to ensuring that you become consistently profitable. Okay? Thank you for watching to the end. I look forward to seeing you tomorrow.